Today, we're going to talk about how to reduce your 2024 taxable income and also how to reduce your 2024 taxes. So whether you're still working or whether you're retired, the 5 strategies that we're going to talk about today could potentially help you reduce your taxes by hundreds or thousands of dollars. Now, you want to stick around for number 5 because it's a strategy that I find is often missed. Also, you want to start now on all of these different strategies because the longer that you wait or the closer that it becomes to the end of the year, these strategies may no longer be available to you. All right, with that, let's dive in. Let's start with strategy number 1, which is contributing to a tax-deferred account. You see, contributions to a tax-deferred account are tax deductible. What do I mean by that? Well, let's just say you make $100,000 a year. So you have $100,000 of taxable income, money that you're going to pay federal income tax on. Well, if you make a contribution to a tax-deferred account, let's say $15,000, well, that $15,000 is tax deductible, meaning your $100,000 of taxable income minus the $15,000 tax contribution to the tax deferred account. Now you only have $85,000 of taxable income, meaning you've just reduced your 2024 taxes. Now, some tax deferred accounts that you're familiar with that you could contribute to are a 401k, 403b, or 457. If available to you at your employer. In 2024, you can contribute $23,000 to these different tax-deferred accounts, the 401k, 403b, 457. And if you're age 50 plus, you can actually make another $7,500 contribution. They call this the catch-up contribution. So for those that are age 50 plus, you can actually contribute $30,500 a year to these different types of accounts. So think about that. That's a way to reduce your taxable income, reduce your overall taxable income, and meaning reducing your taxes in 2024. But you can reduce your taxable income by $30,500 a year. And that's not it. We've got some more to come on that. And then let's just say instead you might be self-employed. Well, self-employed, you could make contributions to a SEP IRA, simple IRA, or a solo 401k. And then anyone with wage income coming in can make a contribution as long as you are under the earnings limit. Anybody with wage income coming in can make a contribution to an IRA. That's also tax deductible. So for 2023, you can make a contribution to your IRA for $7,000. Or again, if you're age 50 plus, they give you a catch-up contribution of $1,000, meaning age 50 plus, you can make a contribution to your IRA of $8,000. Again, all depends on how much income you have coming in, if you can make that contribution to the IRA. Let's just say you fall within the earnings limit. Take a look at this. Think about this. You could be age 50 plus, put $30,500 into your 401k, and then put another $8,000 into your IRA. So now you've just taken your taxable income. You've been able to reduce it by $30,500, and then maybe an additional $8,000 depending on how much you have coming in. Now, something to remember, when you take the tax deduction today, that's why they call it a tax-deferred account. You're just deferring the taxes till later. So you will have to pay income taxes on all of this money when you make withdrawals on it in your future. And in your 70s, you're going to have to start taking required minimum distributions. This is what can sometimes lead to what we call the retirement tax surprise. And I'll include a video on this so you can I'll include a link above as well as in the description below. So that way you understand or have that ability to understand if contributing to these accounts could be beneficial for you or could just be creating a retirement tax surprise for you. Again, link above as well as in the description below. All right, the second strategy to reduce your taxes in 2024, depending on your employer health plan, you could potentially contribute to an FSA or a health flexible spending account, or an HSA, a health savings account. Either way, whichever one you contribute to, you will get a tax deduction for the year that you put the money in. There you go, ways to reduce your taxes in 2024. Now, with the FSA, you get the tax deduction on the money, but the way to keep that tax deduction on that money is you must use the money on qualified medical expenses. Actually, the same for the HSA. There is a difference between the two. The FSA, it is considered use it or lose it. So you must spend that money in 2024. You cannot carry it on to future years. The HSA, you've probably heard me talk about this before. We've got other videos on it. What a triple tax advantaged account. You get the tax deduction that for the year that you put the money in, you can grow it tax-free and make withdrawals tax-free. Plus, this account you can carry from year to year to year. So any unused dollars in this year, you just carry it on to next year. So those are two ways, if again, depending on your employer health plans and what they have available to you, two ways that you can contribute to different types of accounts to use money for medical expenses and also use money for your medical expenses tax-free and also get a deduction on your taxes. Now, before we move into strategy number 3, for those of you just joining our channel, my name's Scott Sierens. I run a retirement planning and investment management firm where we help families and individuals, people just like you, we help them maximize their retirement story. Now, if you'd like to see additional videos on other retirement topics just like this, such as Social Security or how to reduce the taxes on your IRAs and 401ks, subscribe to our YouTube channel as we're coming out with new videos each and every week on retirement topics just like those. All right, let's move on to strategy number 3. All right, the third way that you can reduce your taxes in 2024 is by making contributions to charitable organizations. Now, you might be thinking you already do this, but you've been told by your tax preparer that based on how much you contribute, the standard deduction is so big that you're not able to deduct these charitable contributions. Well, there could be some alternative ways to actually get those deductions on your 2024 taxes. One way might be a donor advised fund. And the other alternative way, if you're age 70 and a half or older, would be a qualified charitable distribution. That's giving directly from your IRA to the charitable organization. Think about that. Money coming out of your IRA is taxable, but you give it directly to the charitable organization. You're able to give it to them tax-free, and that taxable income does not hit your income taxes. Way to still give to charity and get a deduction in regards to your overall taxes. Now, I'll include a link above regarding these QCDs, qualified charitable distributions. You can also find it in the description below. All right, let's move on to strategy number 4 and the often missed strategy number 5 on ways to reduce your taxes in 2024. So number 4 is tax loss harvesting. So let's just say you have a brokerage account with a stock or a fund that has a loss in it. Well, you can do what they call is sell that fund, or really is called recognize that loss. And when you recognize that loss, you may be able to write off some or all of it on your 2024 taxes. And then strategy number 5 to reduce your taxes in 2024 could be reallocating interest-bearing funds. Here's what I mean. Let's just say maybe you have too much cash on hand, and that cash is sitting in a money market or an online savings account. And now that interest rates are up, that money is generating interest. Interest gets taxed at ordinary income tax rates. So what could you do? Well, you take that money that's generating that interest and you reallocate it. You put it into funds or accounts that won't generate that interest and won't generate those income taxes for you. So for instance, you could put it into municipal bonds, which will generate tax-free interest for you. Or you could reallocate it into a tax-deferred account like an IRA, or you could reallocate it into a Roth IRA where then it grows tax-free and you can make withdrawals tax-free. And then another option is that you can take it from where it's at today and you put it into a brokerage account into stocks or equities. And you see, by doing that and having more of a long-term focus, now you're focused on long-term capital gains and dividends, which are going to be taxed at the long-term capital gains rate, which is a more favorable rate than your ordinary income tax rate. I see all the time that people are sitting on too much cash, this cash generating interest, and not taking advantage of these other opportunities to help reduce their overall federal taxes. So, hey, hey, take a look. Do you have too much cash? Can you make some reallocations to reduce your 2024 taxes? Folks, we are just scratching the surface on ways to reduce your taxes in 2024. What might be helpful for you is our free guide to unlocking hidden tax savings opportunities. You can get this at lifemoneyshow.com/taxes. Again, lifemoneyshow.com/taxes. It's going to have actions in there to help keep more of your hard-earned income and hard-earned savings in your pocket versus paying it to the IRS. I hope that you found this video to be of value and benefit. And if so, subscribe to our YouTube channel so that way you get notified as we come out with new videos each and every week on topics like Social Security and how to reduce the taxes on your IRAs and 401ks so that way you can maximize your retirement story. Thanks and have a great day.